You don't need thousands of dollars to start investing. All you need is $100 and a plan. Today, I'm showing you exactly how to invest your first $100 the smart way, so it can quietly grow while you sleep. Here's the myth we need to bust first. A lot of us grew up thinking investing is for people with big savings accounts or people who already understand the stock market. So we wait. We tell ourselves, once I have more money saved up, I'll start. But here's the thing, waiting is actually the most expensive decision you can make. Because the ingredient that does the heavy lifting in investing isn't a huge starting amount. It's time. The earlier your money starts growing, even a small amount, the more time it has to actually grow. Let's talk about what happens to money that just sits still. Think of inflation like a silent tax. Every year, everyday things like groceries, rent, and gas quietly creep up in price. Historically, prices in the US have risen by roughly 3 to 4% a year. So if your money isn't growing at least that fast, you're actually getting a little per every year, even though the number in your account looks exactly the same. Now, a typical big bank savings account often pays interest rates as low as 0.01%. Leave $100 in there for a whole year, and some banks will hand you back about 1 penny as a thank you. Meanwhile, that same bank often takes your money and lends it out to other people for things like mortgages and credit cards at interest rates far higher than what they're paying you. And they keep the difference. Investing works differently. It means owning a small slice of many companies instead of just being a customer, so when those companies do well, a little of that can come back to you. Historically, the U.S. stock market has averaged around 10% a year over the last century, though that number moves a lot from year to year and isn't guaranteed going forward. So if it's this simple in theory, why does it feel so overwhelming in practice? Honestly, because the industry doesn't make it easy for beginners. There are countless apps, acronyms, and people online insisting their way is the only way. A lot of us also carry a quiet fear we'll pick the wrong thing and lose our money, so we freeze instead. That fear isn't silly. Money is genuinely personal. But for your first $100, you don't need a complicated plan. You need one simple, well-understood option and a habit. Let's bust the biggest fear directly. The fear is usually, what if I invest and the market drops and I lose everything? Here's the honest answer. If you invest broadly, meaning your money is spread across many different companies instead of just one, and you leave it alone for years, short-term dips matter a lot less than they feel like they do in the moment. What actually builds wealth is something called compounding. Compounding is when the growth your money earns starts earning its own growth too. Think of that seed we planted earlier. At first, it's just a tiny sprout, barely noticeable. But left alone and watered consistently, it doesn't grow in a straight line. It grows outward from itself, faster and bigger each year, until one day it's a full tree. Your money can work the same way. Let's make this real with some illustrative numbers. These are just examples to show the pattern, not a promise of what will happen. Say you invest that first $100, then set up an automatic transfer of just $10 a week after that. Using a commonly cited long-term average return for a broad stock market investment, that habit could grow to roughly $7,400 after 10 years. Again, this varies year to year and isn't guaranteed, but the principle stands. Keep it going for 20 years, and that same small habit could grow to roughly $21,700. Now compare that to leaving that same money sitting in a typical low-interest savings account. After 20 years, that could grow to roughly $11,000, and because inflation has been eating at its value the whole time, it buys you noticeably less than the number suggests. Same habit, same amount put in, very different outcome, because of where you chose to put it and how long you let it sit. So how do you actually do this safely? Throwing your $100 into one trendy stock you saw on social media isn't really investing. That's closer to gambling. If that company has a bad quarter, your money can drop fast. You've probably heard the saying, don't put all your eggs in one basket. Spreading your money across many companies instead of just one is called diversification, and the simplest way beginners do this is through something called an index fund. Picture a big basket holding a tiny slice of hundreds of the largest public companies in the country all at once. One well-known example is often called the S&P 500, an index that simply tracks 500 of the biggest publicly traded companies in the US. If one of those companies struggles, it doesn't sink your investment, because hundreds of others are still carrying weight alongside it. Here's how to actually set it up. Step 1. Download a reputable brokerage app. That's just a platform for buying investments. Look for one with no account minimum and no trading fees, and open an account. It usually takes a few minutes. Step 2. Transfer your $100 in, then use the app search bar to look for a fund that tracks a broad index like the S&P 500. These are usually labeled with a short few-letter code called a ticker symbol. Step 3. Enter the amount you want to invest, review the order, and submit it. You now own a small slice of hundreds of companies at once. Step 4. And this is the one that actually matters most. Find the setting for automatic or recurring investing and schedule it to invest a small amount such as $10 or $20 every week or month straight into that same fund. A quick note on alternatives, since there's more than one reasonable path. If your job offers a retirement plan with any kind of employer match, that's often worth prioritizing first, since it can effectively add extra money on top of what you put in. If a robo-advisor, an app that builds and manages a simple mix of investments for you automatically, feels less intimidating than picking a fund yourself, that's a completely valid way to start too. And if you don't have emergency savings yet, building a small cash cushion first is a genuinely reasonable move before investing. And I want to be straight with you, this isn't magic, and it's not risk-free. The value of your investment can go down as well as up, especially in the short term, and past patterns don't guarantee future results. This only really works if you can leave the money invested for years, not weeks. If you think you'll need this cash soon, a savings account is genuinely the safer, more appropriate place for it. So here's your one actionable next step. Don't try to figure out the whole plan today. Just download a brokerage app, deposit your first $100 into a fund that tracks a broad index like the S&P 500, and turn on one small automatic weekly investment, even $10. That's genuinely the whole first move. Quick recap, you don't need thousands to start. Time matters more than the amount. Spreading your money across many companies beats betting on one, and automating even a small habit is what actually builds it while life happens around you. You didn't need $1,000, you needed a plan, and now you have one. If this helped make investing feel a little less scary and a lot more doable, stick around. I break down money like this every week. No jargon, no pressure, just your finance sister in your corner. If you want more of these videos, let me know what you want me to cover next. We'll unpack it together. This is your finance sister. See you in the next one.